So let me do an example here just to make things clear. From 2011 to 2016, Pfizer had an average monthly return of about 1% a month and a standard deviation of about 4.36% a month. McDonald's, on the other hand, had an average return that was lower, 0.66, and a standard deviation that was lower, 3.73. And their correlation is 44%. Okay? So how would a portfolio of just these two stocks perform? Well, it's not hard to calculate what that would look like. If you calculate the expected return of Pfizer and McDonald's, this is your weighted average. That's the weighted average of your return. And if you take a weighted average of the risks, the weights are not linear now because you've got this covariance term, but it's going to be the weight on Pfizer times the Pfizer volatility or variance, the squared weight of McDonald's times McDonald's variance, and then here's this correlation here, 44% correlation multiplied by the standard errors, the standard deviations. Question about that? Okay, so now let me plot it for you to show you how this works. So here we have McDonald's down here, Pfizer up there, and if you think about what that looks like, I'm varying the weights between Pfizer, 0% Pfizer, 100% Pfizer. So McDonald's is this position here. We have 0% Pfizer, 100% McDonald's. And the position up here is 100% Pfizer, 0% McDonald's. Okay, that's what it looks like in mean standard deviation space. Any questions about that? Okay. So the interesting fact about this example is not the endpoints, but rather what happens in the middle. Because what we see is that somewhere in the middle, we actually have an opportunity to make everybody better off. We can actually lower the risk and increase the expected return all at the same time. This is motherhood and apple pie, right? You can do no wrong for clients if you can actually lower their risk and increase their average return. And it turns out that that's possible in this region right here. In this region here, you're decreasing the risk and steadily increasing the returns. If you start off at McDonald's, by adding little bits of Pfizer into that portfolio, you are slowly improving the risk-reward trade-off. And that's something that all investors will appreciate. Now, it doesn't mean that they're all going to take the same portfolio. So it depends on their risk preferences. So here's Miss U1. So U2 goes here. This particular individual would like to be, at this point, of a combination of Pfizer and McDonald's. But a somewhat more risk-averse individual might actually be at a different point here. It depends on your utility function, your risk attitudes. But clearly, in both cases, it does not make sense to hold only Pfizer or only McDonald's. This is the importance of portfolio theory. You mix the two together in order to get a better trade-off for all parties concerned. Okay? Now, what's even more interesting is if you introduce a risk-free rate here, a risk-free asset. If you have a risk-free asset that pays 20 basis points per month, 6% or 2.4% per year, then it turns out that you can make both of these individuals better off, the blue and the green, by combining the risk-free return with one very specific combination of Pfizer and McDonald's. And where they will end up on that mix is anybody's guess. They'll hold the same relative proportion of Pfizer and McDonald's, but they will hold different amounts of the risk-free asset depending on their risk preferences. And you agree that with that dotted line, both Mr. Blue and Mrs. Green are better off than they were without that risk-free asset, right? They're more northwest than they otherwise would have been. Any questions about this? Okay. So now let's go back and explore the situation where the correlations change. Now, the correlation is 44%. We estimated that from data. But suppose I were to tell you that that data was faulty, and in fact, the correlation is not 44%, it's something else. I can use that same expression to calculate the various different risk-reward trade-offs and just simply plug in a different number than 0.44, right? So what if I did that? If I plugged in a different number, let's say 0.25, so there's less correlation now between Pfizer and McDonald's. Then I don't get the blue curve anymore, now I get the red curve. Are investors better off, worse off, or undetermined in this case? How do you know it's better off? How can you prove to me that we're better off? More northwest. Yeah, you can go to the west here, or you can go to the north up here. So this red curve actually makes you better off. The lower the correlation, the better off you are. It doesn't mean we know what investors will want to do. You've got to go back and do their utility functions and see where they want to be. But without even knowing where they're going to end up, you know that they're going to be strictly better off because you've gone more northwest. Now, what if we make the correlation even smaller? Let's make it 0. Now, even better, right? What if we made the correlation negative between Pfizer and McDonald's? Well, if it was negative, you do even better still. What if we made the correlation minus 100%? They're perfectly negatively correlated. What do you think would happen then? Well, what you would get is a spike that goes right into the vertical axis. And what that's telling you is that with a negative 100% correlation, there exists one combination of Pfizer and McDonald's that has no risk, and positive expected return. Is it possible to have an investment that has no risk and positive expected return and that is above the risk-free rate? Why not? What happens if that does occur?
So investors take it, and eventually the expected return goes down.
Exactly. If it happens that you can actually get something like 85 basis points risklessly, investors are going to take it, and they're going to take it a lot until the return comes back down to 0.2, which is what the equilibrium rate would be. So this is not sustainable. This is not a realistic example, but I put it there just so you know why it is that we care so much about correlation and look for things that are negatively correlated. Now, what if I go to the opposite extreme? Suppose it's positively correlated by 100%. Well, if it's positively correlated by 100%, then the risk-reward trade-off is just a straight line. There is no benefit to combining these two securities because you're not getting any savings whatsoever. So in that case, you actually don't have two separate assets. You should just pick the one with the higher yielding and higher return asset. Okay, so finally, let me now introduce back the risk-free rate. If I have the risk-free rate and I have my standard situation, this is the trade-offs that I can offer to my investors. If, on the other hand, I have these lower correlations, then look at how the trade-off changes. That's the trade-off with 25% correlation or with 0% correlation. This is the trade-off with minus 50% correlation. And it turns out that as I get farther and farther northwest, the slope of that line is increasing. What is that slope? It turns out that the slope of that line is the Sharpe ratio. So we're back to the Sharpe ratio. If I can maximize the Sharpe ratio, I'm going farther and farther northwest. I'm making all investors better off. So you see, that's what we care about in investment management, trying to give the very best possible risk-reward trade-off. And one quick and dirty way of summarizing that is, what's your Sharpe ratio? How northwest can you go with your portfolios? Okay? So that was the two-asset case. The general N asset case works in exactly the same way. Basically, you're taking an average of all of the various different investments, and your covariances are going to add up along with the variances to what the total risk is. So what you're going to want to do is to really manage those covariances as carefully as possible by trying to find assets that have very little correlation if you can find them. It's not easy. But once you do that, you mix them all together and you get this minimum variance boundary of all the various different assets. And what we want is to be on the upper arc, the efficient frontier, which is the best expected return we can get per unit risk, or the lowest risk we can get per unit expected return. And from that point forward, we will be able to manage our investors' portfolio by focusing on getting as northwest as possible in that particular frontier. And if we have a risk-free asset, we get to the tangency portfolio and combine that with the risk-free asset, and we try to get our investors onto this line as much as possible. And you'll notice that here I've just generated this curve with 3 assets, IBM, McDonald's, and Pfizer, and none of the 3 assets is actually on the curve. What that means is that there doesn't exist a scenario where you would ever want to hold just one stock when you've got 3 available. And this is the power of diversification. You would never want to put all your eggs in one basket when there are other eggs out there that are not perfectly correlated with that one egg. And so this goes counter to the idea of picking winners and losers. Warren Buffett has often said that instead of diversifying and not putting all your eggs in one basket, he prefers to take all of his eggs and put it into one basket and then watch that basket very carefully. Now, if you're Warren Buffett and you really know how to watch baskets, maybe that's the right thing to do. But if you don't have the same level of skill, an alternative is to do this diversification approach. And it's going to run counter to a lot of what drug developers do. So I want to just highlight that cultural gap and prepare you for it. We're going to actually have a number of very talented drug pickers, drug hunters through this class. And I want you to note their reaction when either you or I suggest to them, gee, why not just put together a portfolio of these drugs? They're going to be horrified. They're going to say, well, you have to really think about what you're doing, and you have to use judgment and expertise. Great if you have it, but if you don't have it, is there a different approach? And that's what we're going to explore. Okay, so the tangency portfolio, you already know, that's the market portfolio. And now we get back to this notion of market risk and idiosyncratic versus systematic. Now you see where the market portfolio comes from, and it's very much consistent with the arbitrage pricing theory of that portfolio that has a unit beta with respect to some kind of a common factor. So that's CAPM in a nutshell, but from the perspective of a portfolio manager who wants to construct as well constructed a portfolio as possible.